Hey everyone, welcome back to Lunch of the Market. This is your Friday edition. Oh my gosh, it's almost over. Thank the heavens. What a choppy week we've had the last couple of weeks in the S&P 500 index. This thing is down and up and down and up, and massive sell-offs and then rallies only to fade at the end of the day. I mean, it is crazy. It's not for a weak stomach. So, what have we done? This morning on the bounce, we actually took off some of our risk in terms of the 128, 126 put spreads. We bought some of those back. Okay, what we did to compensate for some of the loss that we took is to actually sell the amount of the loss in 125, 123 put spreads that expire in June. Obviously, at some point, the S&P 500 index is going to settle at some point above some strike by options expiration. So what we're trying to do is just simply get down low enough where it's unrealistic that we're going to get to that level. It is very possible that the S&P 500 index doesn't break 1284 by options expiration. And if it doesn't, then obviously it would have been better to have our entire position on. But the reality is that there was just simply too much risk. The jobs number, had it been a surprise to the upside, those put spreads that we were already short going into the number would have been terrific. We could have bought them all back for much less, probably 50% less than we sold them for. But the reality is, when the number came in worse than expected, ISM was slightly, the service sector ISM was slightly better than expected. So that was a little upside surprise that provided us with some momentum to get to erase some of the loss. But ultimately, we're trading back down. Still not seeing the VIX. The VIX is still below 18. It's actually down on the day, so the panic just isn't there in the markets, but it's just simply getting really hard out there. So until we see something happen in the infrastructure of our country, we think that unemployment stays persistently high. We are not expecting unemployment to come down. We think that we have structural unemployment, not cyclical. Cyclical means it goes in cycles. Structural means that something has changed about the economy that simply means those jobs just simply aren't coming back. We're in that camp. So unless the government does something like an energy policy in which they lay out the kind of fuels that are going to be used over the next 10, 20, 30 years, then it's unlikely that we're going to see unemployment improve significantly until it just simply gradually improves with corporate earnings. But a lot of companies are scared to spend that cash until they know what the regulatory environment is going to look like. So we're probably not going to see the re-acceleration of the economy that we want to until we know the outcome of next year's November election, which means probably a very sluggish 2012. So we'll see if the economy accelerates at the back half of 2011. That's certainly how we're going to approach it for now. We're going to approach our investing thesis that things get better towards the back half of this year. And so we have two trades for you for the back half of the year, one of which is a gold trade. It's actually, I guess you could say it works in all kinds of scenarios. It works in inflation, so if things do get better and we see inflation, it should work. If things don't get better and the scenario is worse, then gold should act as a hedge. So what we've done is we've sold the January 2012 GLD 150, 149 put spreads. Yeah, it's only $1 wide spread, but you get 51 cents for selling it. So the trade would have to go really against you in order, it could go really against you and you could break even on the trade. So the only thing that you're tying up is the margin, but because it's only $1 wide spread, you're tying up much less margin than you normally would for a $5 or $10 wide spread. So it's a really nice risk reward. Obviously your max loss there is 49 cents. That's less than half of the width of the spread. So we really like the risk reward. We do like gold higher. Obviously when you sell a put spread, we just need the GLD above 150. So we don't actually need something miraculous to happen. We just need gold basically to stay where it is. But odds are one of the two things will happen. Either growth will re-accelerate and we'll get some inflation, which should raise the gold prices, or things will get worse and people will go to gold as a safe haven because it's worked for so long. It's worked through the recession. It is seen as a safe haven play despite its volatility, and it's prone to big movements of $20, $30, $40, $50 in one trading session. So that's one trade that we do like. We think that works in a multiplicity of environments, and it's far enough in the curve that you don't really have to worry about it. It's just a payday that's coming hopefully at the end of the year. Okay, the other trade that we like is in the energy sector, EOG Resources. We sold the October 110-105 put spreads during the day between $2.02 and $2.05. Again, we're getting close to half the width of a $5 wide spread. We're out to October, so we've got plenty of time for this trade to work. If you take a look at the last 4 quarters of earnings, EOG turned in an 18-cent EPS number in August, 18 cents in November, then 36 cents in February, and 68 cents in May. Obviously, earnings are accelerating. If they can continue to do this, then we think the stock is attractively priced right here. The forward PE is 18, which is not great, but the trailing PE is over 100, and so it's a story that's really about improving earnings. And as long as those earnings can continue to improve, then the 150-day moving average is, let's see, the 50 days at 110, right? So that's your first line of support, is that 50-day moving average. So that's where we've sold our put spreads. The 150-day moving average is at 102. So obviously there's a lot more safety in the 195 put spread, selling that, right? Meaning you're short the top strike, which is the 100, and long the bottom strike, which is the 95. For those who are new to put spreads. So to sell that 195, there's a lot less risk there because that level is below the 150-day moving average. So in the intermediate time, should we see EOG Resources sell off like it did on the open? The stock has basically rallied from the lows of 107 to 111 during the day. If we see the stock get banged down again, we'll sell that 195 put spread against it in the front months. We simply just didn't get enough premium to sell that spread in the front month, and we certainly didn't want to be short at 110, which is only about $1 less than the stock is trading at right now. And so we want to throw it out on the calendar, get paid, get compensated for that risk that we're taking on, and then in the front months we'll sell those spreads against it as the stock moves down and tests those key levels. Again, the 150-day moving average is 102, and the 50-day moving average is at 110. Obviously, we'd like to see a nice bounce at 110, which is what happened this morning. It traded down to 107. Bounce. It's bouncing the rest of the day. We'll see where it closes, but we like to see it trade back up to 120, at which point we might even look to take off those October spreads. It just depends on where they're trading at the time. Certainly, if we're better than 50% profit and we've got a couple months until expiration, then we'll just simply take them back off the table to use the available firepower to go somewhere else to make a shorter term bet. So that's where we're at. We like those 2 trades. They're going to take some time to pay off, so these are investments rather than they are trades. So be aware of what your risk tolerance is and how long you want to be in the trade, what you're looking for, where your levels and where your comfort level is. All that stuff's important to evaluate, and of course do your own homework on EOG Resources, and hopefully have a reason to get into gold or get out of gold. Right before you take a gold position, you really need to have a worldview and you need to stick to that worldview, because if you get freaked out or scared, then you're likely to make a rash decision, and then the market will probably just turn around in your face and go the other way. That's pretty much what happens. Like this morning, right on the lows, when the 128, 126 put spreads looked the worst, right? That was actually the time to add to them. You could have sold them for 50 cents on the open and then bought them back later today for 31 cents. Would have been an amazing trade in a couple hours, but you know, when the bullets are flying, it's tough to do. So again, to hedge that position, we sold the 125, 123s in the amount of whatever the loss was that we were taking to take off the 126, 128, 126 put spreads in the SPY. That's the ETF that tracks the S&P 500 index. Okay, so be on the lookout for a new episode from America's Favorite Traders from Patty Edwards. We had her on the show last night. It was not a disappointment. She's always terrific on the show, and last night was certainly no deviation from that. She's a wonderful lady. We threw a ton of stocks at her, so you're going to love it. Be on the lookout for that. We're going to try to have that out by Monday, so this weekend it could come out. If you don't follow us on Twitter right now, follow us on Twitter. We'll tweet it out when it's available, or you can subscribe to our podcast on the iTunes. Just search on iTunes for America's Favorite Traders. Sign up, subscribe, check out the other episodes while you're waiting for Patty Edwards. Have a wonderful weekend. Stay cool if you're on the East Coast, because it's pretty hot out there. Enjoy, and we will see you on Monday.